Hello ladies and gentlemen, thanks a lot for locking into this special episode. As you can see, something completely different. Going to be covering the Russia-Ukraine situation from a completely different angle to anything you're going to see on YouTube. The headline is attention grabbing, will Russia destroy your savings? Do I think that's justified? Yes, I do. This stuff, let's be honest, it's going to affect everyone. Whether you're a trader looking at the types of things that I look at, and you can see incredible detail, amazing episode for you today, or whether you're just a normal consumer, right, and affected by the geopolitical tensions, whether you've got savings in the bank. Obviously inflation is likely to be affected by the situation here that you see on the map. People's savings will clearly be affected by that, whether you're a homeowner, whether you're a stockholder, whether you buy things every day, and who doesn't? Everyone does, right? You're going to end up paying higher prices if things escalate, as we've seen here. So it really does affect everyone. The way I look at it is in incredible detail, and I think that is important. I think people just skip over things and look at headlines. You need to obviously understand it properly, and that's what we're here to do today. So can't wait to get cracking with this episode over the next 10 to 15 minutes, not even that long, so worth your time, because like I said, it affects everyone, and it'd be foolish to ignore what is staring you right in the face. So just to start off, we already know unfortunately it does appear that there is an increase in the number of troops, Russian troops on the Ukrainian border, and that's obviously not only affecting markets. We have to take a moment and spare a thought for the people who actually are here in this area. They're doing an amazing job keeping their strength up, and on both sides. I don't want to take sides. Obviously it is what it is. I'm not really here to talk about politics and who's right or who's wrong. My concern is, how does it affect the markets? How does it affect people every day, in terms of inflation and so on and so forth. The things that we're all affected by. In particular, obviously I will talk about it from a trading perspective, because I am a full-time trader, so institutional trader, so that is important. And in fact, talking of institutional trading, proper trading, right, none of that random garbage that most people are looking at, let's be honest, the markets have been affected by the Fed negatively, in terms of a changing regime, possible rate hikes coming, in fact definite rate hikes coming, obviously rising inflation. On the plus side, we've had positive earnings countering that. There is definite evidence now that I'm going to show you that the market is ignoring this completely the last couple of weeks, and probably even this whole month. I'm focusing purely on geopolitical tensions, right? And that is what we're going to be looking at today. Let's have a look at that evidence. I think that evidence is really, really clear. And if you're trading and you don't recognize that the market is looking at geopolitical tensions almost 100% at the moment, then you're in big trouble, because then you're looking at completely the wrong things, okay? So that's okay, we're here, let's get educated, all of us together. If we look at, so I say this many times before, you've got to look at the markets as a whole. Those of you that have followed have seen this many times before. It cannot be denied. The markets are moving together, almost in lockstep, right? The crypto market, the treasury market, FX market, even the commodity market, and then you see S&P, okay? One for one almost, moving down this week. Very negative week for the markets. And it is fascinating, as much as obviously I am sparing a thought for the people who are there on the ground. We have to remember that's much more important, the people that are actually in this escalation zone. But as a trader, it's slightly different. Obviously, I'm thinking more about how is the market perceiving this situation. And, it's amazing. I hear Ukrainian people saying, we're still very positive, but unfortunately the market is taking this situation very negatively. You can see that the number of troops does seem to be increasing. Obviously, there's denials on all sides about that. And we can see last week, there were rumors early in the week that Russia is pulling back, and that was positive for the market. Then we heard from NATO and some of the allies that actually we're not seeing evidence of that pullback. And what happened? The market completely tanked towards the end of the week. So clear evidence that the market is ignoring data things like the PPI, which were at multi-month highs, crazy numbers. You would have thought that'd be negative for the market, and actually the market went up because obviously we heard that Russian troops were pulling back from the border. It's fascinating, right? Can you see this situation here is almost driving the market one for one? Okay, whatever's happening in that situation is driving the market, and all markets, as I've already said. Okay, so you've got to be on top of these things. Now, as I said, the market is giving us clear evidence that it's ignoring the things it's been focusing on before, economic data, obviously the Federal Reserve even more so, and inflation. It's ignoring those things right now. Retail sales was very, very positive. Despite that, we saw a massive slump in the market the following day. So just to summarize, down 1.6, which adds to the previous week, which was also down 1.5. We're down almost 9% on a closing basis. And that is really important because, as you may have seen on the thumbnail for this video where I've put minus 15%, why have I put that? You've got to realize, as a trader, you have to know that this level, 10%, is very, very important for the market, because below that starts to get into like dangerous territory of a significant correction. Okay, doesn't mean bear market, which is minus 20%, but look how close we are now. For like almost a year and a half since the COVID recovery, we have not tested this level. Now we seem to be consistently testing it. So it's going to be fascinating. I keep saying this not to patronize anyone, because I want to help you. You have to be on top of this situation, because that situation is going to affect this situation, basically the floor that you see in the markets, this kind of 10% corrective area, which we're very close to now. I'm not saying it will go through that. I don't know. It could go the other way. It will. I can't obviously second guess how things will transpire over the next few weeks with this situation. Obviously, let's hope and pray that it does de-escalate. And there's tentative signs that there will be. And of course, this is not about getting into the politics of Russia versus Ukraine and the US and NATO and all of that. It's about understanding market perceptions, because if you're worried about how it might affect you, your savings, inflation, all these things, if you're involved in the market like I am, what matters is market perception. Okay, and right now market perception is very negative of it. Don't want to get too complicated or technical, but it's important, right? Markets are much more technical and complicated than people who drive around in flashy cars and all of that nonsense want you to think they are, because they have great rewards, and where there's great rewards, obviously it does require a bit of technical expertise. So looking at things like price earnings is important. We can see that price earnings have pulled back the ratio over the last kind of couple of weeks. We can see that here, in particular last week, right, coming back to around 20, and that has been driven purely by prices, okay, not earnings, because earnings have been strong. I think 33% year-on-year growth in earnings. 85% of companies have reported. So it's important to recognize that this entire negativity is being driven by geopolitical tensions, right? Because otherwise it will be driven by earnings themselves. Earnings are actually positive, right? So if earnings are positive and the price earnings ratio is dropping, that is a massive clue that the market doesn't care about earnings right now, which means it doesn't care about some of these more fundamental factors. It cares about what? This situation. That is why all markets, and I was going to say the S&P, but all markets are correcting at the moment significantly, because there's just tension around, right? People are just throwing all those metrics, those numbers, those fundamentals out the window and ignoring them, and I expect that to happen continually for the next I would say couple of weeks. I mean, so many examples of this. If we look at Federal Reserve, right, the minutes came out. If you looked at the minutes during the week, they were actually very dovish, quite positive in the sense that, yes, there is obviously rate hikes priced in, but the probability of a rate hike of 50 basis points has now dropped to 35%. It was as high as 50%, right? You can see it here. It was very, very high 1 week ago, right, the probability of a 50 basis point hike was 50% 1 week ago. It's dropped quite dramatically because the minutes suggested that inflation, in the Fed's opinion, was down to more supply issues related to COVID. They obviously expect that to unwind. They're not really too keen on a 50 basis point hike. I'm scrolling around a little bit here because there's obviously a few things going on. But in terms of the 50 basis point hike, so the Fed is not too keen on that, was the clear message from the minutes. You would have thought that would be positive for the market, but it wasn't. Right? Like I keep saying, I'm going to keep coming back to it. This situation is very, very at the forefront of all investors' minds, and obviously it should be in everyone's minds, not only from a human perspective. Obviously we don't want people to be caught in conflict, but also from a personal finance perspective, in terms of savings being eroded by potential dangers of more inflation to come, right? And we see that here is another very, very good clue that the market is concerned about geopolitical factors, because look at crude oil, right? Crude oil continues to be heavily supported because people are worried, obviously, that these things will escalate and production will be hit, and this is bad for inflation, which is again bad for the value of any holdings you may have, in particular obviously savings, and we can see that here. The only sector, apart from financials, which is pretty flat to be honest, the only real sector that is up this whole year in 2022 is energy. Right? I mean, really, it has not been a good performance for markets in 2022. Okay, and that cannot be denied. That may change, I don't know, but clearly it hasn't. This is obviously some data from last week. Last couple of things before we just wrap up. I do want to just quickly talk a little bit about results, because obviously it's important. I'm not just giving you lip service. These are the results over February. Obviously been a stellar month, a fantastic month actually, and you can pause all of this. I won't hold it up for too long. Everything there in terms of all the statistics, $23,850 over the month in terms of trading. But this is what's more really interesting. Okay, look at the shorts that I've been taking this month versus longs. It's almost 50-50. Very rare for me. But I've actually taken the same amount of money out of shorts and longs, and actually my daily volume, right, in terms of round turns, has actually been more on the short side than on the long side. And also what is more interesting, or just as interesting, is look at my win-loss ratio on shorts. Okay, 76% on shorts, 56% on longs. If you're a trader and you're not aware of your general statistics, it doesn't have to be in this much detail, but even just generally, you've got to question how serious you are if you're not looking at these sort of things. My point is, this helps me. It gives me more confidence to hold short positions, okay? And I won't get into the details. Obviously, you can check that out if you're in the G7 group. Obviously, I have been talking a little bit about actual trades that I've been taking on the short side, and I've been much more confident to hold certain shorts, in particular in the last week. And that's again down to this situation going on, because I understand it. Now, just to finish off, last few things, very, very important. I talked about the price earnings ratio. Now, if we look at the relationship, so you can see here, remember I showed you in the first chart, the price earnings ratio has been dropping. So if we just quickly flick back to right to the beginning, where is it here? So you see the price earnings ratio. I was saying earnings have been strong, yet prices are dropping. Why would that happen? Because of geopolitical tensions, okay? There's fear in the market. We see that here. The point is that it tends to be heavily correlated, and it makes sense, with rising interest rates. Okay, very important you understand this, because I don't feel that people who really trade in the sort of commercial space, all these kind of retail traders, and nothing wrong with being a retail trader. Obviously, since I've left institutions, I'm also a retail trader. But the majority of them do not look at interest rates, right? I don't know why. It makes no sense to me why you wouldn't, because you can see the interest rate market is driving every market, right? They're all correlated. And it makes sense that when interest rates rise, price earnings ratios will drop, right? Of course, it makes complete sense. Obviously, equity, all valuations, right? Crypto, equity. I don't want to hear from anyone saying, I don't trade equities, I trade crypto. You should be looking at this even more, okay? Because interest rates will affect crypto valuations? Of course they will, right? It's expected cash flows in the future from your holdings. What do you think you're investing in, right? You've got to know this stuff. If you don't, or anyone tells you that you don't, then you need to seriously question whether that's the right advice. Point is, I've heard some conflicting things in the market recently. So you can see here the price index, PCE price index, is just a measure of inflation that the Fed prefers, but ultimately it's inflation, right? So we know it's been about 6-7%. You can see it. Treasury yields are miles away from that, right? However, the alternate way of looking at it is, if you look in the past, the Fed has been quite reluctant, obviously, to raise interest rates when the economy is doing well, but relatively speaking, we are starting to see some softening happening, and the Federal Reserve is typically tentative to obviously raise rates in that scenario. However, it is expected to do that this time. Okay, but yields have already shot up before they've even started, number one. And then number two, if you look back to the last time when the economy was softening and the Fed was raising rates, the 2-year yield, when it was already elevated from the current Fed funds rate, which you can see here as well, a gap, it tended to go sideways. So I'm hearing a lot of analysts, institutional analysts, saying, this 2% jump, can you see the jump in the 10-year Treasury rate up to 2%? This is interest rates in general, 10 years, longer end of the curve, but still good general measure of interest rates. Some people are expecting it to go sideways. Some people are saying, hey, it's miles away from where inflation is, it needs to go up. Fascinating. That's what my point is. You need to be watching this, because if this continues to go up dramatically, then what are we likely to see? That 15% that I talked about on my thumbnail. This is going to become a very real prospect. 15%. If obviously we go sideways, I think this is going to be the key determinant, not geopolitical tensions forever. Obviously, at some stage, I think this will hopefully start to de-escalate, and the market will. And historically, we always see that when we see geopolitical issues, they tend to be short-lived, maybe a few weeks. Hopefully that's the case here and everything dies down. And this isn't the thing that's going to kind of determine the direction of the market for the rest of the next few weeks and months. Although in the next couple of weeks, I think it will be. Longer term, I think interest rates are going to be the big thing. Final slide before I let you go. Let's have a look at the calendar for next week. Very quiet, right? We've already had advanced GDP. It's just preliminary GDP, the second cut. Really nothing there. Bank holiday on Monday, which increases the danger of a gap going into Tuesday, but a short week. Next week, to summarize, like I said, it's all going to be about geopolitical tensions. Okay, so the first slide that I had here, next week is all going to be about this. And then going forward, hopefully the weeks after, as this dies down, it's going to be all about interest rates. Click the button to subscribe. Hopefully you found that useful, whether you're a trader or just a general member of the public. And can't wait to see you next time.